the so-called Cathie Wood ARK fund, those stocks, the innovation stocks, et cetera, that have been hit so hard, they're really sold out. I wouldn't be surprised to see Amazon, up in the 4,000 somewhere. So we can't, words just don't do justice to what I think's coming. When we say we have leverage, massive leverage, those are just words. But I think when it starts happening, it becomes reality, and it's going to just speed everything up. We saw a little bit of that in March of 2020. Look how we saw a 35% drop in the S&P in 3 weeks' time. That's what I mean. Leverage speeds everything up and makes it worse.
Hello, everyone, and welcome to the NTG Market Update. This is the first installment of a series of financial and stock market interviews. I will be having future guests on, so if you are interested, please hit the like button, subscribe, and turn on post notifications for our future interview sessions. We have a very special guest today, David Hunter. First, I just want to say that this interview is sponsored by us, Northern Trading Group. We are a group of experienced investors who run a consulting and live alerts educational group for equity and derivative investors looking to make money in the stock market. Join our group through the link in the description below. And without further ado, I'd like to take the privilege to introduce our special guest, David Hunter. Again, David is a 40-plus year Wall Street veteran and macrostrategist. David also has a quarterly letter that he sends out to subscribers regarding his thoughts on macroeconomic trends. So you can contact him and get in touch with him for that. David, I just want to say welcome and thank you so much for coming on with us.
Yeah, thanks, Ghana. Thanks for having me on.
Yeah, as I was mentioning before as well, we are all very avid followers of yourself, your thoughts and ideas. We've been following you for quite some time, mainly, since about around the March, 2020 correction. At the time, we were predicting quite a melt up ourselves, both my partners and I. Following the Fed kind of stepping in, and providing stimulus into the markets. Looking online for someone, as I mentioned before, you couldn't find too many people with the same a similar thesis, and we came across your, at the time, 4,000 S&P 500 prediction at the time, which, to most people sounded crazy, but we were pretty in line with that. And from there, we've just been following your ideas, and you've been, really spot on, especially, to preface the March correction. Your prediction on rates was, right spot on in January as well. So that's just completely really great in itself.
Yeah, thank you.
Yeah, and so just to start off, I'm sure everyone is very familiar with you, of course, but for those who aren't, just give us a brief introduction of your background, how you got started on Wall Street, your time on Wall Street, and how your time in the banking sector as well as Fidelity shape your views on macroeconomics, the Fed, and the market as a whole.
Sure. I came into the business in 1973, so it was at the height of the Nifty 50 bull market. And in my first year, I was working for a bank in Indiana in my college town. I had majored in finance and wanted to get into investments, so I was in the investment department in a smaller bank, doing both bank portfolio and trust portfolio, which gave me the access to, or the exposure to both bonds and stocks. Gave me a lot of hands-on experience I wouldn't have gotten in a bigger organization. So, sometimes starting small helps. But anyway, it was a time when the Nifty 50 topped out, and we went through the biggest bear market prior to 2008-9 that we have seen, was the 74 bear market. So I got a real early introduction into what risk meant and the importance of managing that risk. So I attribute that to a lot of my, kind of my grounding going forward. I think it was the best experience I could have was to have a bear market right in front of me. I went from there to another bank out east, and then from there, I had to choose at that time between, because it was a bigger bank, I had to choose between bank portfolio, which is bond management, or trust portfolio, which is more, gives you the stock market exposure. So I chose the trust department side, and have been pretty much an equity guy ever since, but have a real grounding in bonds as well. From there, I went to Textron, in-house, running their equity portfolios, had top 1% performance for 5 years while there. Got recruited out of there to Fidelity, ran U.S. portions of global portfolios for Fidelity and the pension side. And then ran ITT Hartford's active equity effort, and was a chief investment officer in New York City of a $1 billion firm at one point. So that was the first half of my career. Second half of my career has been as an investment strategist, a macro strategist, and I really feel that money management side, where I was pretty senior levels in equity management and more of a value manager, that having that along with the macro stuff really helps me as a strategist. And now all I do basically is forecast markets and the economy. I also early on learned the value of being a contrarian. Have been a lifelong or career-long contrarian. And as you guys know, because you follow me, contrarian investing is something that not a lot of people really understand or are comfortable with, because a lot of times I'm making statements that are far removed from where the market consensus is, and yet that's oftentimes where I have my best ideas, is being far away from the crowd.
Yeah, exactly. I think especially with the influx in retail traders at the time, at the current time, I think the contrarian way of investing is just so much more powerful as well.
Yeah, and it's interesting because you find today, when I was doing it back in the 70s and 80s, there weren't nearly as many people doing it. But today you have everybody claiming they're contrarian or trying to think contrarian, but it's not an easy thing. When the crowd is going one way, it's very hard to have any conviction or confidence in being far removed from them. I'm very comfortable with it, but I've been doing it for 48 years, and I also think I was born a contrarian. So it's not hard for me to have. In fact, I'm very comfortable having a position that's totally opposite to what the vast consensus believes. But that's over 48 years of observing this, very few people have that comfort level. They want to be with the crowd. It's just human behavior.
Makes sense. Yeah, makes sense. Also, just first off, could you briefly summarize for the viewers your overall thesis and expectations for both the equity and precious metals market over the next 6 months to a year in 2022?
Sure. I just came out with my first quarter letter, what I call my 2022 outlook. And in that, I raised my equity market targets. I had been at 5,300 for the S&P, 18,000 for the Nasdaq, 42,000 for the Dow, and 2,900 for the Russell 2000. And those were all aggressive targets that most people questioned, and people were coming closer to them, but I was pretty much the high on the street. And I did my work at the end of the year, and the more I looked, the more I said those targets are just not high enough. When I say melt up, people quote the term melt up a lot, but very few people really understand the concept of a melt up. We've only had a few of them in history in the equity markets. 1929, maybe the Nifty 50 in 1973, certainly the Nasdaq in 2000, but not very many others. It's not just a big rally; it is something really to behold. And when I took a look at a lot of cross markets and a lot of underlying stuff in the equity markets, I came away saying I'm just not. My targets are not aggressive enough. I raised my targets in this letter that came out last week to S&P 6,000, Nasdaq 20,000, Dow Jones Industrial Average 45,000, and the Russell 3,000. Now, those may sound insane. In most cases, I think they're 30 to 40% away from where we're at. And I'm also saying we could get there in 3 to 6 months' time, depending on when it gets started and how fast it really gets going. But parabolic melt up is really what I'm talking. And parabolic, we've had, when you step away and look at a longer chart, we've had a parabolic melt up since March 2020. But the last stage is going to be the steepest of all. So it's going to be almost a vertical move where momentum begets more momentum. People feel the train's leaving the station and have to get on. And it's not going to come just from psychology, although that plays a big role. It's also going to be a very viable argument. People are going to look and have, for one reason or another, going to have confidence that this thing has legs and could go on for years. It's not going to be somebody jumping in because they think the next 2 or 3 months is good. This is going to be people across the spectrum, institutional investors and retail investors, getting very bullish for reasons that I can guess at. I obviously don't know. If I were picking, if I were guessing, I would say the likelihood is that the tightening that's going on, we're all, and it's been going on for many months, everybody's been speculating about Fed tightening. And when Powell had his spoke in late November and early December, he basically capitulated and said, this inflation has legs. It's not just transitory, and we have to deal with it. We need to nip it in the bud. We're gonna speed up our taper, and we're probably gonna tighten in 2022. That was a big change, and that began the move in interest rates, where you've seen the 10-year go from 135 to 180 basically, and I think it's on its way to 210 before it pauses. That's a big move in a short time. And what I learned way back in the 1980s is the power of the bond market, or what we used to call the bond vigilantes, in terms of them doing the tightening and not needing the Fed. If the rates are being pushed higher by the bond market, the tightening's already happening. Everybody's focused on when's the Fed going to hike rates? When's how many rate hikes are we going to see in 2022? To me, that's not the important thing. It's all happening right in front of you. It's happening. The tightening is already occurring, and I think the likelihood is that as we move through the first quarter, it's going to become, the narrative is going to shift from, the Fed's going to hike 3 times or 4 times. The narrative is going to shift to maybe the Fed's not going to hike. The reality is that the rate move will have already taken place. And if that's the shift, all of a sudden you've gotten out of the way something that's been in the way for most of the last certainly 6 or 9 months, of everybody fearful of when's the cycle going to end? When's the Fed going to start tightening? I was one of the earliest ones talking about Fed policy mistake that would lead to a bust. And now everybody's worried about that. So I think if the reality is, or the narrative shifts from Fed tightening's just around the corner to, hey, the tightening's already occurred, you're going to have the wind at your back again. And I think coinciding with that very well could be a sense that, and again, I'm talking about narrative, not necessarily reality, but a sense that for at least the next several months, that the worst of COVID is behind us, that Omicron is kind of the weakening variant that you see as a virus starts to dissipate, and that we've learned to deal with that, and you get away from this constant counting of constant testing and counting of cases and hospitalization, and that it starts to feel like normalcy is creeping back into our society, into our economies around not just in the US, but around the world. If there's a feeling that COVID's being put behind us, that will be a huge wind at the back of the markets. So I think it's a combination of, maybe the narrative changing on Fed tightening and a narrative moving towards COVID is no longer, going to shut us down. Those two things may be the impetus for the melt up. Could I be wrong? Maybe it's something else, possibly. But my work, just when I look across the board, it just says, yes, we got to get this correction out of the way. But once it's correction out of the way, there's another leg up that's going to be the biggest leg yet.
Awesome. Yeah, that makes a lot of sense, actually. I totally follow that narrative part because I'm really thinking that mainstream retail and media, they really need something to push, and they typically always do it. Whenever they get bullish, they usually just put some sort of fear-mongering articles, scare everybody, and they start to load up. And it's kind of the reverse here, in my opinion. And I'm just really wondering, for the sentiment based, because typically, especially in a contrarian view, when people are bullish, that's when you're bearish, and when people are bearish, that's when you're bullish. To very briefly sum it up, but in the melt up, if I'm understanding correctly, you're predicting that the kind of pullback / mini correction before the melt up is when people are very bearish, and that's really the time to be buying. But in the final parabolic rally, you're actually saying that sentiment is pretty much bullish for everybody, right?
Yeah, it's exactly. I think if you step back in history, at any of our major tops in history, and this can be not just U.S. Look at the Japanese top in 1989. Look at the Chinese top that we had prior to the last couple of years. But certainly in the U.S., look at any of our major tops. And at tops, you have the highest bullishness that you have. At bottoms, you have the lowest bullishness that you have, or the highest bearishness. And so in between, we're not at a top or a bottom here. We're in between. We're on our way to a top, and we have corrections along the way. So you do correct along the way, and that's really what's kept me bullish, and why people keep saying, why do you keep raising your targets? You had a target of 4,000, then a target of 4,500, then a target of 5,000, then 5,300. Now you're saying 6,000, and I always raise them well in advance of when we get there. So I'm not playing good till we get there, and then I'll raise it. I'm seeing things as I go along, and I adjust my targets for that. So what's kept me bullish has been the amazing skepticism, what I call the wall of worry, that has continued to remain as we've climbed up here. It starts to dissipate, and then you get a little pullback, and people get bearish again. Then it goes to higher highs, and then starts to roll over, and you get, as for a long time, I don't remember what it was, a year or more, we didn't even have a 5% pullback, but the 3 or 4% pullbacks were enough because people got skeptical very quickly. And I think, again, we're having a correction here. The Nasdaq's corrected 10%. The Dow and S&P, only a few percent, but we are seeing people start coming out of the woodwork saying the top's in, we've seen the highs, we're going a lot lower, the bull market's over. So you are getting some of that sentiment coming back in here. And really only a few weeks ago, I was one being lectured that I was missing my own melt up, that this thing was off to the races. And I stuck to my guns and said, no, I think we're still in a correction. There's a lot of stuff underneath the surface that tells me, there's divergences, et cetera, that tell me this thing has more correcting to do. And that this recent rally is a year-end rally, that it doesn't have legs. And now we're seeing that. So yeah, it's kind of a long answer to your question, but yes, I think at the end, when we see, if I'm right, we see 6,000 on the S&P, you will see more bullishness in the sentiment numbers than we've seen at any time, even at the top in 2007. So I think we are moving in that direction, but there's still plenty of skepticism out there. So it's there's going to be a lot of people having to get on the bullish bandwagon.
Yeah,
I'm fully anticipating that when we finally get to the top, people are going to be lecturing me about how I'm missing it by turning bearish. That you don't understand. This thing has years to go. That's what I fully expect at the top.
Yeah, definitely. I see a very overwhelming, a negative sentiment of extreme fear, sort of, all over the market. Both, J.P. Morgan, Goldman Sachs came out just this past week, predicting 4 rate hikes in, the year we're in right now. So, I think it's quite bearish, and I do agree with the sentiment that that is the main driver that sort of brings us higher. Do you think any sort of stimulus like Build Back Better plan has any sort of legging into the melt up thesis?
I don't think you need it. I have no idea. Trying to predict what our politicians are going to do here, trying to predict what Joe Manchin's going to do here. I just don't make a career of doing that. So I have no idea. If I were guessing, I'd say you're going to get some slimmed down version, a very slimmed down version of what they're trying to do. I think a lot of the stuff they put into that bill were non-starters. They just don't have, they certainly don't have the Republicans in any way on that, and they had a couple of them, more conservative Democrats really fighting it. So they're going to do something. I fully expect. I don't think Joe Manchin's a diehard fiscal conservative. I think he understands his voting constituency, but I think he'll find a way to vote for something if they remove some of the distasteful stuff. But I don't think it really matters whether it happens or not, because most of the stuff in that is both more political and longer term. It's not anything that's going to impact the economy in the next 6 months. So it really isn't necessary. Monetary is helpful, certainly, but we have, because they've, pumped $5 trillion into the economy and into the system. There's money sloshing around. People try to say, "Oh, the Fed's tapering, and that means there's less liquidity, et cetera," or certainly less than expected. I think there's plenty of liquidity. It's if psychology changes. And I do think, interest rates above a certain level become a problem, and have certainly helped with this correction. But I think a lot of stocks will overlook if we're moving, as Mike called is 2.5% on the long bond. If that happens, that could happen in a matter of weeks, or it could go, like I said, I think we can go to 210, back off a little bit, maybe back off 20 basis points, and then run again to 2.5. That run from, let's say, 190 to 250, 250, 260. You could have just so much wind at your back in the equities that they kind of ignore that. It may affect growth stocks as we move closer to the top, and then commodities and so-called value stocks kind of take the lead more. While rates are still moving up, or it may be that most of the rate moves happens before the biggest part of the melt up. I can't know that, but I do think that it's more psychology, the economy itself, what's already going on. If supply chain issues clear up, you can have a strong auto sales component. Housing may be impacted a little bit by this bump in rates, but I think the home builders are still going to they have plenty of backlog. I think that they can still be strong in terms of their producing. Industrial stocks, I think, can be helping to fuel it. So there are lots of things that I think are already built into this coming rally. and into what will drive it. So I just don't think fiscal stimulus is all that important.
Yeah, just to add on that, actually, because of the recent couple months in the rally, we've really seen the indices kind of continue to pull up higher and higher, mainly led by, like you said, the leading sectors, industrials, energy, financials are picking up, and for the tech side is mostly just the large, FAANG companies, Apple, Microsoft, Google, etc. So, but what we've seen is actually in the last few months, a lot of the high growth multiple tech stocks have been taking a severe beat. Many of them down more than, I think, 50 to 70% from their peaks. In the melt up, do you believe even these high multiple growth stocks can recover as potentially the market's pricing in 3 or 4 rate hikes this year?
I think so, because number one, I think that, like I said, that rate narrative may dissipate. And again, people don't realize the focus I have is not on what is the Fed going to do. My focus is on what is the narrative and what is the reality. So if the narrative is for 4 rate hikes, and that narrative changes to where, oh, gee, I don't think they're going to hike anytime soon, it doesn't matter what happens second half of this year, and maybe the Fed does hike. I'm not saying, I'm not so focused on trying to guess what the Fed's going to have to do or is going to do. I'm more focused on the narrative, and the narrative has gotten ahead of itself, in my opinion. I think we could have, I think this week's inflation numbers are going to be high, but I think there may be things that come in the next few months after that say, hey, maybe inflation, we're seeing the peaks here and it's starting to back off a lot, or maybe a little, or maybe it'll be mostly the economy is starting to soften, and so, just like we remember in 2018 when, Powell was, pretty much telegraphing that he was going to tighten, and they did tighten. And the market, Christmas Eve of 2018 went through its swoon, or, leading up to that and into that. And then all of a sudden he had to reverse himself. You could have that if the economy softens here. So it's more the narrative that I think is driving the markets. And so if the narrative changes, it's not so important, what is the Fed doing, or what is the Fed going to do? Because I don't think the Fed is going to continue, I think, on the tapering course through the end of the quarter for sure. I don't see that changing. The real question is what happens after that. And right now, people are, getting more aggressive and anticipating Fed tightening, rate hikes, and I think that could go the other way. But I think I lost what you were asking me beyond that.
It's okay. You touched on it pretty well. Just to answer, you do have conviction on the small caps at high growth.
Oh no, that is what you're asking. Yeah, I do think the small caps will come back here, as I've said often on Twitter. I think the final melt up will be a broad rally. It won't be narrow. I think it will be both growth and value, and part of that is because I think like I said, the rates could take a pause or back off a little bit. And the narrative could change some, so it's more friendly towards growth stocks. But basically, I think the so-called Cathie Wood ARK fund, those stocks, the innovation stocks, et cetera, that have been hit so hard, they're really sold out. So they could bounce 50% and not go to new highs, but they could have a 50% rally in the melt up, which would outperform almost all other things and still be, just basically a counter trend bounce. But in terms of the FAANGs, I think the FAANGs will go to new highs. They've been correcting here, particularly, the Amazons of the world, the Netflixes of the world, the Facebooks, and the Googles. Those have corrected quite a bit here in the last month. I think I think basically you've seen pretty good bases built through the last year for another run up. I wouldn't be surprised to see Amazon, up in the 4,000 somewhere. So, it'd be a pretty good run. I think you're going to see broad participation, industrials and certainly commodities, basic materials doing very well, but also small cap stocks, the Russell. If you look at my targets, that basically says Russell's going to outperform the other indexes, the bigger cap indexes. So I think it's going to be a pretty amazing rally in terms of not something that everybody's going to be picking apart and saying, oh, it's just being led by a handful of stocks. I think it's going to be very broad.
Yeah, your Russell targets are quite bullish. So we're definitely hoping to see that come to fruition.
Yeah, think about the Russell. It's not as much a growth index. The small cap index. It's really led by a lot of small banks, a lot of financial stocks, and some small economically sensitive stocks. So that are more domestically focused. So if we have a sense that the narrative is moving towards, hey, the Fed's not going to tighten as much as we thought, or isn't going to tighten, or it has to ease, or whatever it will be, you're going to see the wind at the back of the economically sensitive stocks. That favors the Russell. More domestically focused companies. And if rates are moving up towards 2.5, as we've seen with this latest rate hike or rate move, financials do very well. So their concentration in banks will favor the Russell. So I think both of those things help the Russell index.
Yeah, I just want to briefly touch very quickly. So if we're pretending this scenario where the Fed does in fact rate hike and perhaps project 3 to 4, which matches the narrative, would that change anything in your melt-up thesis?
Well, let me put it this way. I just totally disagree with the idea that the Fed's going to be hiking aggressively in the first half of this year. What happened in the second half of this year remains to be seen, and I think could go either way, but probably my forecast for a bust is based on Fed tightening. So I still think that's very possible. I really have a hard time with. I think the narrative has gotten way ahead of itself in terms of, the Fed might hike as early as March. The Fed's going to hike 4 times, and before this is over, if rates move to 210 and beyond that, you're probably going to see the narrative where they're going to say, oh, the Fed's going to start hiking rates a half a point at a time. You're going to see things where the markets, it's more psychology is feeding into the narrative. So I don't know, hypotheticals in terms of what happens if they do have to hike. I don't explore things that I don't really expect to happen in my time frame. Now, it may be that we don't get as far as I think, and the narrative doesn't reverse like that, and so this thing rolls over sooner. But I don't see anything in the next 3 months other than the narrative in terms of actual Fed action that's going to change.
Yeah.
Okay, so sounds great. I just want to add on to this rates part. So I believe you mentioned when you believe that the market tops out or peaks, that rates will be near 2.5%. Is that right?
Well, no, I'm not. My bond call and my stock call are not necessarily coincident. Like I said, I do expect over 2% on the 10-year as soon as the next couple of weeks. It could go straight from there, and you could be at 2.5 before the end of the month or early February. More likely, it pauses at say 2.10, just over 2%, and you might spend a month. You might spend 6 weeks in kind of a consolidation pattern where it's between 180 and 210, or between 190 and 210. I have no idea. I'm not a trader. I can't, and I don't think any trader can know that anyway. But that's a possibility. And so I think a lot of times what happens to investors, is they want everything in a linear fashion. Gee, rates are going to 2.5. Well, then, we're only going to think about rate hikes. We're only going to think about the rates going up. What if rates go sideways for a month? And the market gets comfortable with a narrative that says rates aren't going any higher. Even if they go higher after that, you had a month where the market didn't have to worry about it because the narrative was changing, right? So a lot of it is and this is where 48 years of experience comes in handy, is I find most investors, particularly most retail investors, but also institutions, think they want everything in very lockstep fashion. Just because I have a 2.5% 10-year forecast doesn't mean it's all coinciding with the melt up. You could, like I said, you could have most of the melt up happen in a month or two's time, and it might be a time when, it's not the rates are going down, but they're not going up. I have no idea. All I know is when I look at the breadth of my analysis, which includes cross-market stuff, includes looking at individual groups and stocks, includes technical and fundamental analysis, everything comes to a conclusion that says this market has room to run, and looks at sentiment, certainly. So I don't really take one market and say it has to coincide. My forecast has to all come together in one nice, neat package, because I can't know how these markets are going to move in very short term, short meaning, 1 or 2 month periods.
Yeah. And David, so moving on to the Fed, we personally take the view that as so long as the 10-year Treasury yields essentially are below the rate of inflation, capital will continue to sort of funnel into risk assets such as equities. Do you agree with this assumption? And do you think that the current drawdown, let's say this past week, it's just an overreaction to the shift in the stance of the Fed?
It certainly is primarily a reaction to the combination of the bond market and the narrative. The narrative about the Fed and the bond market is really, I think, what's driven it. Maybe a little bit of the fears over Omicron spreading through the population, and employees not. One of the airlines announced today they had several thousand people out of work because of COVID. So there may be a little bit of that, but I think it's primarily the bond market moving up so fast, interest rates moving up so fast, and the narrative about Fed hikes. People treat the reading of the bond market or reading of tips and things in terms of what it's telling us about Fed hikes as if that's fact. It's not. It's just, they're trying to extrapolate from what the bond market is doing to what that implies for the Fed, but that can change on a dime. So yeah, I think the pullback here, the correction, the correction really started in early November. Underneath the surface, you started seeing the correction, and you've had a couple ups and downs in that process. So we've basically been in consolidation for 2.5 months, or 2 months anyway. And I would argue that that's just natural part of sustaining this bull market. So I don't necessarily worry too much about exactly what's driving it, but I do think on the surface, certainly it looks like it's mostly surrounding the fears of Fed tightening. And then, once that settles in, once you've discounted that, you'll have, I think, strong earnings, strong economy, and a sense from investors that it can handle 2% 10-year, without a problem.
Okay, makes sense. And with the accommodative Fed policy that we're seeing currently, very generous, and the strengthening economy through 2022, what specifically do you think triggers the bust? And do you think it could stretch out into, let's say 2023, maybe a little bit later, before the bust actually hits in your thesis? And the hawkish change in the Fed policy, do you think that this triggers a longer decline before we kind of see results?
What's the last part of that again? I'm not sure I followed that.
So the last part I was just kind of saying. So do you wouldn't kind of a more hawkish change in Fed policy overall trigger the market to decline a little bit longer before an economic decline sort of hits?
Yeah, I'll try to unpack that a little bit. My thesis on the bust, and I put it in a formulaic equation sometimes just to make it easy, but it's 300 trillion in global debt, combined with quadrillions in notional value of derivatives, means we have leverage, massive leverage. You add to that a pandemic that has caused a very fragile economy. So yes, we've had statistically an amazing rebound from what happened in March 22 or second quarter of 2020 or second quarter of 2020 in terms of the shutdown of the economy around the world. But what underneath the surface, we still have a lot of fragility that came about because of what COVID has done. So there's a lot, that the statistics don't really bring out when you see, home purchases are strong, but there's no inventory. We had issues with commodity prices, so builders stopped building. You've got an auto industry that looks okay, but they probably fell short 3 million units last year because they didn't have chips to build the cars to satisfy the demand. So you've got those kind of issues. Then on the other side, you've got people who haven't paid their rent for 2 years, landlords who haven't received their rent payments for 2 years, student loans that haven't been paid because the government basically put a moratorium on. You've got so many things out there, and you've got a lot of people pulling out of the workforce, particularly baby boomers who are saying, I'm not working anymore. This is too risky. I've got enough to be able to stay on the sidelines to retire. Or young people who say, gee, the government's giving me these, nice payments. I'm just going to stay out of work until I use them up. So you've got labor issues. There's just so many things out there that are not normal. And so there's what I call fragility. So you got massive leverage plus fragility, meaning that, and by the way, that fragility comes into the picture because it means that when things do turn south, that fragility can exacerbate the downturn or speed it up. So those are factors that we haven't had in previous downturns. And then I just think, if the Fed if inflation continues, and I do think inflation is going to continue up, the Fed is going to ultimately have to crank things down. And I just think we're going to find, as we've seen of late with the markets, that the economy responds to tightening in a more exaggerated way, meaning it doesn't take a lot of tightening because of those other things I discussed, leverage and fragility. It doesn't take rates having to go. You don't have to have necessarily an inverted yield curve. You don't necessarily have to have the Fed funds rate go up 400 basis points, nothing like that. So I do think that we'll see what I call a fast and steep unwind come as a result of what wouldn't normally be seen as a policy mistake, but will be, because the Fed won't realize it until it's too late. Leads and lags mean that they won't know that they've gone too far. So that's still my guess, is that the Fed will be, as they always are, the main culprit in triggering a downturn. and just because of leverage, a normal downturn turns into something much worse. But in terms of exact timing and all that, I think we got to get through the melt up before we can really worry about is it. I have been saying, and I continue to say, I think the bust starts in the second half of this year, meaning bust being economic downturn. But could it stretch where it doesn't happen as soon because the melt up push things out a bit? Sure. But at this point, my simplistic timing is melt up first half, bust sometime second half.
Right. Yeah. The bust is definitely a big call because you're calling like 80%, right, from the market peaks.
Well, keep in mind, bust means economic downturn. So bear market, yes, I'm calling for an 80% bear market that accompanies the bust, but people use bust interchangeably with 80%. My 80% call. The bust is the economy, and that's why you'll get the 80% down in the market. But the market will lead the bust. So if you let's say you get a top in the market, you get to my 6,000 S&P and you top out in the second quarter, meaning you might see the highs in April, but it might take a month or two to kind of retest or go down and then retest or whatever. And then let's say the bear market starts closer to later in the second quarter or closer to mid-year. You're probably talking about the bust then being a fourth quarter event at the earliest because the market leads. If we top out sooner and we go straight down, the bust could start in the third quarter. So who knows? But yeah, 80% bear market is a big call. We haven't had anything like that in the post-World War II era. We had a 90% bear market in the 29 to 32 market, 1929. So it's a big call, but that's my work says that's potential. Could it fall short of that? Sure, but I just think we've had, as I call it, a 39-year secular bull market where you look how far this thing has come from 1982 and understand it's been driven by, we've created such excesses and imbalances out there that it won't surprise me when everybody's pushing buttons trying to get out. That's the other thing we have is with derivatives and with ETFs, et cetera. It's a lot simpler. You don't have to go through a portfolio of stocks now and say, which ones do I like? Which ones don't I like? Which ones am I selling? Which ones am I keeping? People just say, I want out of the market and basically sell an ETF, an S&P contract or whatever. You could have waves of that pushing markets down in size, in amounts that we haven't seen in previous bear markets, in daily amounts.
Right. Just to add to that bear market, because typically bear markets, the length of time are usually a lot shorter than bull market rallies, right?
Correct.
So
yes.
During this bear market drawdown, do you post the economic bust? Do you believe this bear market will last significantly longer, or would it still follow the typical length of time for bear market?
Yeah, I have said that I would not be surprised if the bear, peak to trough is shorter than the 2008-9 bear market. And in fact, I think the bulk of the bear market could happen faster than the bulk of that one, which the biggest part of that bear market was October 2008 to March 2009, right? This could happen at least that fast. So that doesn't mean the whole thing is in 6 months' time, but it could happen, that the bulk of it is in that. Now, I don't think it's going to be a straight down. I think you'll have multiple legs to it. But my guess is because of the leverage, because of the imbalances, you're probably looking at something that's going to happen faster than normal. And not be dragged out by it for a couple of years. I think most of the bear market's contained in a year and probably less than a year.
Yeah, just to add to that, yeah, I mean, you mentioned it, but with the excessive spending and debt levels, I think if there's a time in history, for something like your prediction to occur, we are currently in it, right? So, I
Well, think
definitely agree
about
with you.
this. I used to use, and you guys follow me long enough, I used to say constantly, we have 250 trillion in global debt, and we can't wrap our head around that. I mean, what is that? We talk about trillions like we used to talk about millions, and yet it's a real number, and it's a number that is just out of anybody's ability to manage. And then you talk about quadrillions and notional value derivatives. So those are huge numbers. In just the time since the the March 2020 swoon to now, that 250 is now 300 trillion, and so 50 trillion has been added to global debt in 2 years, in less than 2 years' time. We're just we're seeing geometric leaps in things that are already way out of sight. So we can't, words just don't do justice to what I think's coming. When we say we have leverage, massive leverage, those are just words. But I think when it starts happening, it becomes reality, and it's going to just speed everything up. We saw a little bit of that in March of 2020. Look how we saw a 35% drop in the S&P in 3 weeks' time. That's what I mean. Leverage speeds everything up and makes it worse.
Makes sense. And also, David, I'd like to ask you. So the velocity of M2 has been at record lows, right? But yet we've seen inflationary pressures, due to both an increase in and as well as money supply, and as well as supply chain disruptions as well. You could say. Do you expect that the velocity of this to increase as the economy heats up? And as this, what do you believe possibly ultimately drives inflations to intolerable levels and forces the Fed's hand in acting hawkish?
Yeah, I'm a monetarist. I'm a big believer in Friedman and stuff, and I'm certainly not a theorist. So that people could do circles around me, but my belief is that velocity is a plug-in number. In other words, it's yes, turnovers. We know turnover is not happening at the rates it used to with money for any number of reasons. But I think a lot of for a long time we had subpar growth for decades, in spite of money growth. And it's a simple equation, and the thing that had to go down to offset that was velocity. So velocity is a plug-in. It's not really you can't measure the velocity in any other way that's serious. So I believe what you will see is on the other side of the bust, when inflation really gets going, you're going to have the opposite happen, where velocity is going to be increasing because money's decreasing, and yet the economy is moving up and the inflation is moving up. So yeah, but I don't, I think the simple answer as to the next 6 months is there's plenty of liquidity out there. There's plenty of fiscal spending going on. We monetized a lot of our fiscal stimulus. And there's leads and lags. That doesn't all happen in the 6 months after you do it. So there's still plenty of that to provide the wind at your back to keep the economy growing. And I do think supply chain issues are getting cleared up. So I think all of that goes into GDP being relatively strong. That, like I said, you could run into a situation where you see consumer spending starting to lag because of the hike in rates, because of the rise in the bond rates, et cetera. Housing could start to run into some issues. And those things the Fed will pay attention to, even if overall economic growth is continuing to chug along at a pretty good pace. So there's lots of things they'll see, I think, that are going to be cross currents out there. But anyway, yeah, I guess the short answer is velocity to me will change, but it'll change not so much because all of a sudden, money's turning over as much as the dynamic in that equation changes.
Okay, just feeding on this then. Precious metals have been consolidating for quite a long time now. So would you say that this increase in money velocity is perhaps the final piece to drive precious metals higher, or is there something else that you're waiting on?
Yeah, just to be clear, I don't think velocity is going to change dramatically in this cycle. I don't expect in the next 6 months velocity to be a story at all. So I don't think it has anything to do with, I'm calling for 2,500 gold before the bust. So in the next 6 months, I'm calling for silver to go to $50 before the bust. So the next 6 months, I don't think velocity has anything to do with that. On the other side of the bust, the 2023 to 2030 period, when I think gold runs to 10,000, maybe 20,000, when I think silver runs to $400 or higher. Sure, velocity can be a part of that story. Inflation is going to be a huge part of that story. But in the next 6 months, I don't think at all. But I do really believe that we are finally going to see precious metals come out of this consolidation they've been in for the last 15 months or whatever. More than that, I guess. I think you're seeing signs that they're going to emerge from this consolidation, and in the melt up and in the run with inflation here, finally get going. And that may surprise people because rates are moving up. But as we started early on talking about, real rates are still pretty negative. So I think it's more the weak dollar that I expect, and inflation will drive precious metals higher, sharply higher.
Okay, I see. Very, very thoughtful there. So do you have any thoughts on China or stocks trading in the Chinese space? They've been sold off significantly because of China's government pressures and clampdown on regulations and so. Do you just have any thoughts in that space?
Not with any conviction, but what I will say is I think China is one of the surprises that could help in the melt up. If China does at this point finally say, hey, we've gone far enough, we've got to, yes, we're trying to rein in some of our credit issues and we're trying to, take care of the inflation that broke out, et cetera, but we can't afford to go much farther and we're going the other way. If that happens, and it's an if, I'm not close enough situation there to feel I can give a conviction forecast, but if that could be a help to certainly the melt up. On the other side, in the bust, one of the wild card possibilities out there, call it what you may. It's certainly not predictable, but it's also not something that's coming out of the blue. The massive leverage in China could really exacerbate global. Because keep in mind, my bear market is a global bear market. My bust is a global bust. So China could really be a big negative that will help drive that, and have ramifications for every economy, and certainly the U.S. economy. So I do think that's a reasonable possibility, if not a probability. And then on the other side of the bust, I think it remains to be seen, because if you look at the leverage that has driven the Chinese economy since the early 2000s, it's off the charts. I mean, it is. The whole globe's going crazy with debt, but their leverage is off the charts. If that truly gets going on the downside, we may find this Chinese miracle is nothing of the sort, and that they have to dig out for a long time. My better guess is that coming out the other side of the bust, they will contain it. I mean, they'll get hit hard in the bust like we will, but they'll contain it. And I think coming out the other side, the likelihood is that using the comparison to 1989 or after 1987, I think China may be the U.S. of 1989 or 1987, post 1987, and we may be the Japan of post 1987, meaning Japan topped out in 1989 and hasn't come close to getting back there since. And we went on, speaking of markets now, but we went on to many, many times what our indexes were then. Our stock soared, whereas Japan went down. I think that may be the case on the other side of this, is that China kind of both economically and market-wise becomes leader in the post-bust era. Because there's a lot of problems that are going to be around post-bust for the U.S. I mean, the good news is our banks are in better shape than most of the banks around the world. So that's not our issue this time. I don't think, not that we can't see one go under, but I think our banking system is better capitalized than it was in 2007-8 for sure, or 2008-9. And, Europe, Canada, Australia, Asia have bigger financial problems going into this, but we have other issues that we, just what we're doing with our crazy, fiscal expansion. I mean, we're doing some really stupid things that they're gonna be big drags going forward.
Yeah, I follow China quite a bit, so it'll be interesting to watch. I do think they're in quite a tight situation right now. You saw some of the Chinese stocks, not just as a government regulation, but some of the step back of stimulus as well. And then now you're seeing some of the housing issues over there as well. So it's interesting to watch. One thing I'd like to ask you as well, David. So contrary to what we've seen since the March 2020 correction, where Nasdaq has taken quite a lead over the S&P, do you think that possibly in the near future we see a sort of flip situation where some of the banks and some of the more value companies are able to prop up the S&P a little bit better than the Nasdaq and possibly see a little bit more outsized gains?
Yeah, I mean, if you're talking about the next few weeks, certainly possible. As I said, in the melt up, which is what follows this consolidation, I think it's going to be both. I think you're going to see financials play, you're going to see industrials play, you're going to see materials play, you're going to see autos play, you're going to see home builders play, you're going to see FAANG play, you're going to see semiconductors play. You're going to see small and large cap plays, as I said earlier in the interview. It's going to be a broad rally, so it's not so much either or. I think the street is getting caught up in a narrative that says, "Oh, tech's had its day; it's over, and now it's time for the value stocks." And it's not that the value stocks are not ready for a big move, because I think they are. But I don't think it means the death of the tech sector yet. Now, if we're talking about beyond the melt up and we're talking about the other side of the bust, the next cycle. So, if I'm calling for a secular top here, and I've made this comment many times, the top in this cycle, meaning 6,000 S&P if we get there, or what have you, Nasdaq at 20, that top will stand for decades. We will not approach that top again, in my opinion, for decades, if ever. So I'll say decades because I don't want to go into a collapse story that I think is certainly a 2030 story. But if you assume we have cycles to follow, it's going to be at least a couple decades, multiple decades before we get back to the levels we'll see this year. But that doesn't mean you won't have cyclical bull market on the other side. So if we go down 80%, you can take, let's say we're at 6,000, we go down 80%, that takes you to 1,200 on the S&P. The S&P can quadruple, and that takes you back to 4,800. You're still far below 6,000, right? So you can have a big run coming out of the bust, out of the bear market, and not come close to making new highs. Now, but new highs will happen in the commodity sector, in the industrial sector, in the precious metals sector. Those will go on to multiple new highs, but the overall indexes will be dragged down by this cycle's leaders. So if you go out beyond this cycle, your question about tech versus value is much more relevant. Next cycle is going to be a commodity investor's dream. It will be the biggest commodity cycle in history. But the next cycle, your leaders of this cycle, meaning, the FAANGs, a lot of the tech stuff, will be facing distribution for years to come. Every time they lift their head, there'll be a new crowd of investors who say, I finally got back to my cost, I'm getting out. I mean, look what happened after the Nasdaq topped out in 2001. It took over a decade to get back, right? And through that whole decade, they lagged because every time they lifted their head, somebody said, no, I'm getting my money out. People don't like to sell the loss, but when they get their money back, they sell. So you have distribution. And that's something I've learned over many cycles of investing is this cycle's leaders are next cycle's laggards. And next cycle's leaders will be a whole new group of stocks. So I do think value and particularly commodities producers are going to have a wonderful time in the 2023, probably second half 2023 through 2029 or 2030.
Okay, makes sense. And also, David, what are your thoughts on oil in relation to inflation as well?
Yeah, oil. I'm kind of the outsider right now, and I could be wrong for sure. I mean, I did pretty well in calling oil from $10 up to 75, and then I kind of got off, and it went to 85, and I said, up around 85, I said, I think we're seeing a cycle peak. And we're heading back towards 60, and we did that. But I've stayed with the view that it was going to stay in a range between 60 and mid 70s. And we've obviously moved up above that range by a little bit. And now it remains to be seen. Are we going to see it roll over and head back down towards 60? Or are we going to see it go on to new highs? Those are, to me, that's the question that'll be answered in the next month. I'm still sticking to the belief that the probabilities favor, oil rolling over here. But I do have a, very negative view of the dollar. I'm looking for a big fall in the dollar. So it's counterintuitive to think that the oil's going to fall very far if the dollar's falling pretty aggressively. So I may be wrong on oil, but at this point, I'm still in the belief that, oil's not where I would look to put money. It's not, to me, it's and I also have a view that oil in the bust can go back under 30, they can go back into the 20s. So it came from, basically single digits during the, the March swoon and rose all the way up here to 80 or in the 80s. I think it's going to go back, not all the way back, but back towards 20, back into the 20s. And then oil becomes a huge story in the next cycle. That is part of that commodity story where I can, my forecast is for $400 oil by the end of this decade. So I'm kind of on both sides of the fence on this one, depending on your time frame.
Okay, so last question for you, David. Moving into sort of private market valuations, they're at all-time highs with equities. We currently, not just in the US, but worldwide, we have an influx of unicorns. When this economic downturn comes, it will be quite massive, I think, for some of these private companies, especially given their inflated valuations, and some of their funding rounds. And obviously, I'm sure you're aware, some of the logistics behind angel investing, venture and whatnot. So I'm thinking that we'll see quite a bit of pain in some of these companies, and a lot of them going down under. We see some of these private companies spending quite a bit, given that there's such a large flow of money in these companies. What are your general thoughts on that, if you're following the private markets at all?
Yeah, interesting. I have said often that people forget, and I'm not so much the venture stuff, but in a lot of the private equity is what we used to term back in the 80s, leveraged buyouts, right? We changed the term. It was much, leveraged by the history in the 1980s when Mike Milken was around, and leveraged buyouts had a great run, and then they started running into the big problems. We kind of changed the name to private equity. It sounded much more friendly than leveraged buyouts, because leveraged buyout had a bad connotation for a while there. So people don't realize when you say private equity, it sounds fine. And frankly, a lot of endowments and a lot of pension funds, particularly public pension funds, have gone to private equity. It solves a puzzle for them because it doesn't give you the volatility that you get in the stock market. And so they've loaded up on private equity as a way to say, hey, we can generate extra returns there, but not with the risks, the volatility that we see in the public markets. I think they're not understanding that there are risks there that are every bit as big as a stock market. And as a result, they're kind of looking at private equity as more stable and less risk, so that they feel their portfolios are maybe, they've reduced the risk of their portfolio, and they're generating theoretical returns anyway that look good. I think you're absolutely spot on in terms of this. I talked about leveraged buyout for a reason. I keep saying the big story behind this bust is the massive leverage. Part of that leverage is private equity. And when that reverses, leverage is a very dirty name when you're going through a bust. I mean, it just, you don't have anywhere to turn because you've got to meet your debt service obligations. If you don't have debt, you can survive. If you have a lot of debt, you may not survive. So that's on the leverage equity or private equity area and leverage buyout area. Venture capital is not my field. I don't know. You probably know better than I do, but it stands to reason. If we go through a real tough time in the global economy, there's lots of that is higher risk as well, so it will suffer. I don't think we're going to have too many prisoners, taken in this bust. The areas that I always point to as the places where I think we could see positive returns in a very negative return environment are two: U.S. Treasuries and U.S. dollar, because people run to the dollar and inflate safety trade. Not from here, because I expect the big, drop in the dollar first. But at some point in the bust, I think the dollar will be protective, and so will Treasuries, because I'm not, as long as they have the printing press, U.S. Treasuries are not at risk. They will be at risk by the end of this decade, but this cycle, I think they will be a place to hide. So those are the two places. Other than that, I think pretty much every asset is going to be under duress.
Okay. Thank you, David. And before we close, do you have anything you'd like to add to the viewers? Any thoughts, ideas?
Let's see. Other than just a longer term view on bonds, that people should really be cognizant of the fact that, I'm not talking about the next several months, but on the other side of the bust, if we are, and I'm talking about inflation going from negative probably in the bust, I think we could see a a bit of deflation in the bust. From there, by the end of the decade, we could be at 20% inflation rates or higher. Interest rates will track that, so we could be at a 15% long bond or higher by the end of the decade. That means bonds are going to be a losing proposition for most of the next cycle. Bonds have been a huge winner from 1981 until now. It's been a 40-year bull market in bonds. People need to understand that's coming to an end. I do expect one more move down during the bust to maybe even 0% 10-year. So it's not quite done yet. But on the other side of the bust, we are looking at a big bear market in bonds. And the only reason I highlight that, bring it up at the end here, is just investors should be aware that the game's going to be a major, we're going to be in a major game-changing environment where bonds are not a place where you can feel you're reducing your risk. It's going to be, because it captures so much more money than, represents so much more money than the stock market. It's also going to represent so much more loss of money when rates start moving up aggressively. So you're getting a little taste of it here with the rate move, but like I said, we're moving now from 135 to 2%. Wait till 10-year moves from close to zero up to 15% over the course of several years. That's when you find out how big the losses can be in your bond portfolio. So people should be aware of that. They should also be aware on the equity side that index fund investing has worked very well for the last 39 years because you had that drop in interest rates over that 39-year period, that 40-year period. So you had the wind at your back in terms of as rates move down, PE multiples, price earnings multiples move up. And so that helped the indexes. We're going to have the exact opposite in the cycle that follows the bust. As rates move up, price earnings ratios compress. And so as they compress across the board, in general, they put pressure on the indexes. So the indexes won't have the wind at their back. They'll have a very stiff headwind. And so index investing will not be nearly the successful approach that it's been for the last 39 years. In fact, active investors for the first time in a long time are going to find it fairly easy to outperform the indexes. So just kind of leave people with those two bigger picture thoughts.
Okay, that sounds great. Just a reminder, this interview is sponsored by us, Northern Trading Group. Enjoy a free 3-day trial, link in the description. And also, David, tell the viewers where they can find you, how they can contact you, and as well as about your quarterly letter.
Oh, sure. I'm on Twitter nearly every day, so you can catch me there at Dave H. Contrarian. And beware, there are a lot of fake accounts out there where they misspell Contrarian. So you'll find my profile picture, but with a different spelling of Contrarian. It's not my account. There's only one Dave H. Contrarian, and that's spell Contrarian the proper way. And in terms of my quarterly letter, you can direct message me on my Twitter account. If you want details, it's by subscription, so there's a cost to it, but I do put out a quarterly letter that includes all my forecasts and my rationale for my forecasts.
Okay, that sounds great. Yeah, just to avoid that, I'll likely just link your exact Twitter link in the description, and maybe even include maybe your LinkedIn profile as well, just so people have a way to contact you and make sure it's the real you. I know there's a lot of Twitter bots and whatnot, so that's an issue I think Twitter needs to solve. But
I just don't understand. But you're right; they do need to solve it.
Yeah, for sure. Yeah, definitely. Yeah, we've run into those issues too. So, but yeah. Anyways, David, I'd like to really thank you so much for your time and joining us as well. It was a great discussion and real pleasure speaking with you. And we covered, I think, pretty much every topic. Multiple major topics. So I'm sure the viewers will have learned a lot from this, and have many takeaways from the interview. So, thank you again, David, and we look to have you back on very soon.
Yeah, my pleasure. Thanks, Ghana. Thanks, James.
Thank you.
Take care, David. Have a
Take
great
care.
week.